I'm going to start out with a couple of questions. Let me start with you, Katherine. Could you describe the long-term secular case for companies that focus on climate change adaptation and mitigation, and maybe provide a couple examples?
Sure, Alan, thanks so much. And maybe one point of context before we dive in. I was looking at the other folks who are participating in the conference, and I'm really delighted that this is truly an investment oriented conference. All of us these days are in discussions around sustainability, climate, and broader topics of ESG. And one thing that has made the field a little tricky to navigate is that sometimes that's a compliance-oriented conversation, sometimes it's a regulatory conversation, and it's really wonderful in this particular gathering to have this be a true investment-oriented conversation. It's very much aligned with our approach at Putnam. Again, where these functions sit within different organizations is really important and really telling. And so our sustainable investment team at Putnam is just that, an investment team. We are managing dedicated assets and helping the whole investment team here at Putnam become more fluent in relevant sustainability issues. I say the word relevant on purpose. If I think about the whole arc of my evolution as a sustainable investor, way back 20 plus years ago, when I first started working on these topics, I was in a lot of conversations where there still was a great desire to hold these two things separate. So you could talk about climate over here, you could talk about business economics here, but many people wanted to kind of keep the two separate. We've all witnessed in the last 20 years a gradual convergence on this front, in many ways an unwelcome convergence, but the more urgent and relevant an issue is, naturally, the more it can affect directly your investment decisions, not in some abstract, far off, far away way, but in a really very near term and vivid way. A lot of investors focus mainly on the risk-oriented part of climate change, which is totally warranted and important, and I'm sure covered in lots of other sessions today. What's equally important to me and my team as equity investors, and I suspect to Kim's team as well, is that anytime you have a pressing challenge in the world, the opportunity to address that challenge and potentially to solve it, or at least offer potential solutions, is also more valuable. And so with every risk in finance, there's a flip side of that risk, which is an opportunity to either manage the risk better or potentially solve the root problem. And that's where we are right now when it comes to investing in climate. At Putnam, we have two main tools that we use to inform our work. For the work to be investment additive and also relevant for sustainability, we believe it needs to be context specific and forward-looking. That might sound like it goes without saying, but there are a lot of ways to incorporate climate considerations that are not tailored to the specific investment context, or in our case, the specific companies we're looking to invest in. So the research we do is very tailored to individual company context. For example, a software company has really different climate considerations than a heavy industrial company. You should be asking different questions. Your research needs to be tailored to those two different operating contexts. The second dynamic is that it needs to be forward-looking, and in this regard, we've created a gigantic forward-looking map, and the map is centered on the question: what is needed for thriving? Thriving across all dimensions, social dimensions, individual human health, and also planetary health. So those are the two sets of frameworks that really guide our work. And on that forward-looking solutions map, there's sort of an endless list, again, of challenges, but also potential solutions. I'll give you just one and then turn back over just to kind of set the stage for what we might dive into. Our team has just completed a big paper on circular economy that is out in the public domain now. Many of you already know, if you're at this conference, the idea of the circular economy is that instead of extracting resources, using them, and then disposing of them in a very linear way, you design from the beginning for use, reuse, recycling, so that you can have maximum utility out of those materials and also minimum energy requirements and maintenance requirements. There are a lot of company specific ideas that go with this that I can talk to in a minute if that's helpful. But you take a theme like that, you can see it play out across all kinds of different companies, all kinds of different business models, all kinds of different geographies. It's a really rich area to look for. Again, this unity of positive impact and also positive economics. I'll pause there.
Great. Stepping back a second, Kim, can you tell us about the philosophy and practice behind the GMO climate change strategy?
Yes, and let me start by saying I really like that framing that Katherine presented in terms of the opportunities that are available to us as a result of the climate change issue, the clean energy transition. And so I'll start with a brief history of climate change investing at GMO. We really have to link it back to our founder, Jeremy Grantham. So Jeremy Grantham splits his time roughly evenly today between continuing to be a very important presence as a value investor at GMO, but also in his seat as the head of the Grantham Foundation for the Protection of the Environment. And so, going back, over the course of the last decades, Jeremy has been one of the most influential voices that sits in that intersection really between investing, research, spreading the word, being an evangelist for the importance of a climate change solution. And back in 2010, he identified climate change as the most important issue for investors for the next 100 years. He actually used the term global warming, kind of an old-fashioned sounding term, but that was the term that was in use back then. So in 2010, he made that statement, and yet we didn't start this strategy at GMO until 2017. So what was going on in those ensuing years? We actually began investing in renewable energy sources within my group, within the focused equity team in 2011 as part of our overall resource equity strategy. We recognized the importance of renewable energy as a power source. And so alongside other sources of power in our overall resource equity strategy, we began investing in renewable energy sources. And what we observed between 2011 and the foundation of this strategy, the forming of this strategy in 2017, was two things. The dramatic drop in the cost curve around the production of renewable energy. By 2016, 2017, we'd crossed that important threshold of $50 per megawatt hour, which meant you could make the statement that the production of renewable energy was actually completely cost competitive with fossil fuel production, and it had become more a question of scale and intermittency. So those foundational economics were in place. And the second important thing was that what was going on in that ensuing 6 or 7 years was we had developed a robust enough universe that we could have diversified exposure to a number of business models oriented around mitigation and adaptation. Back in 2010, we couldn't safely have made that statement. So that got us comfortable that there was a robust universe with which we could select stocks around the theme of climate change solutions, again, broadly bucketed around mitigation and adaptation. So the philosophy is to invest in those business models that are directly related to mitigation and adaptation. Now, there's a lot of different approaches you could take. There's broader approaches where you're investing in companies whose own practices are as forward-thinking as they can be, best practices around sustainability, but whose underlying business model doesn't actually have anything to do with the solution. Our strategy is pretty pure in that we really only want to invest in those companies whose business models are directly linked to the solution. So that's the foundational philosophy. And in terms of the process, I would say, the only thing I'll say at this point, and then I'll turn it back over to you, Alan, for further questions, is the selection, the security selection within the universe that we've identified orients around valuation. So finding those business models and those companies that are most attractively valued within the overall opportunity set, we think gives us some protection and gives us a better chance of being able to generate strong returns while staying very much true to the theme.
So Katherine, could you talk about your strategy and if it differs or is similar in terms of, are you looking at solely companies that are working towards a sustainable future, or are you looking at companies within a broader range who are the leaders in their field or other areas as well?
Yeah, I can say a little more about that. And maybe just to amplify what Kim said, there's been a really important evolution over the last 10 to 20 years in the range of potential investments in this arena. We are well past the stage where in order to invest in renewable energy, you have 3 choices and they're all very volatile companies. Like, this is a seriously robust investment universe at this point. And that's a really important ingredient for anyone who's aiming to put together a well-diversified, thoughtful, kind of full solution portfolio, as opposed to something that serves a very narrow purpose. So from an investment and client matching kind of standpoint, that's a really important development. In our work at Putnam, we actually have 2 main strategies. One is Putnam Sustainable Leaders, and the other is Putnam Sustainable Future. They are what they sound like. So our marketing team has done a great job in naming these portfolios. Sustainable Leaders are not just best in class in terms of ESG sufficiency. We're looking for companies where the excellence in the relevant sustainability issues for the individual company is making the company stronger over time. So creating a more resilient company with sort of this positive feedback loop internally. So the sustainability excellence is not just coexisting with a good business and decent valuation, it's actually fueling those dynamics over the long term. That tends to be larger cap in orientation. The Putnam Sustainable Future portfolio, again, is what it sounds like. This is the one that is focused on solutions and links more directly to that map that I referenced earlier, this question, what is needed to thrive? So we're asking that across multiple dimensions. And again, here we're looking for companies where the actual product and service that they produce is directly contributing to a positive outcome in the world. And again, this link between fundamentals, valuation, and sustainability is really vivid. One thing I'd like to emphasize in this regard, and I think Kim's approach and ours have this in common, is that we have also finally exited the era where we are not only thinking about fundamentals and sustainability as 2 different things, but we're thinking about them as somehow opposed. For a long, long time, there was sort of this zero-sum view when investors were looking at sustainability, and a really deep-rooted presumption that if a company was doing great on sustainability, it was automatically somehow disadvantaged in terms of their economic context. That has almost completely flipped at this point. Again, it is partly because of the urgency of our times, but these days it is really easy to show the through line from a company that is investing thoughtfully in the sustainability issues that are relevant for their business setting and the long-term financial results that accrue. So I can give lots of examples of that if it's helpful, but that through line is where we're really focused, and it's increasingly easy and vivid to see that even on a shorter term basis.
Well, while we're there, why don't you give us one example of a company, just to make it a little bit more of a concrete example of a company?
Yeah.
That.
Sure. So one company that is good for examples, because it's a pretty familiar business, is Ball Corporation. They make aluminum cans. Not a single person I've ever met who has never seen an aluminum can. So a very straightforward business. I will say I've covered this company for a couple of decades now, and for a long time this was a perfectly good business, but a relatively quiet business. It grew volumes more or less in line with overall beverage volume growth, generated decent returns, but nothing especially dynamic happening within this market. Over the last 10 years or so, a couple of things have happened. One is that Ball's own customers are increasingly focused on materials intensity and recyclability. There's been a wave of interest not only in the beverage producers, but in their own customers in these environmental dynamics and the footprint that is inherent if you're trying to sell single-serve beverages. And Ball itself adjusted its own strategy. It used to be a much more diversified company. They really doubled down on aluminum in large part because of this recyclability and the advantages that it could give to their business over time. So what have you seen? You've seen a company that has gone from growing revenues 2 or 3% to revenues growing 6 or 8 or 10%. You've seen massive expansion in terms of the capacity at the company and the ability to serve their customers in different ways over time. You're starting to see the returns from those investments come through. And so this is just one example of a company in one specific area where having those improved attributes on sustainability versus many of their peers who are offering different products and services has given them a leg up in terms of growth, returns, and also ultimately the valuation of the stock.
Great, thanks. Kim, I know that for many years, GMO has had a reputation of at least being willing to be contrarians, to go against convention. Are there any holdings or strategies in your climate change portfolio that you have to explain to people who look at it and think, why is that in a climate change portfolio?
So, Alan, I know you have seen a high level look at our portfolio, and there's a very good example of that. And so I mentioned in my introductory remarks that we're interested in investing in those business models that are oriented either around the mitigation or the adaptation to climate change. On the mitigation side, at the outset, we made an important decision to invest in those companies, not just the companies that are providing the end solution, but also those companies that are providing the key inputs to that end solution. So that could mean, something as simple as a chip manufacturer who is making silicon chips that control the drivetrain or the battery management of an electric vehicle, for instance. Nothing very controversial there. It also means that we're investing, though, in those companies that are providing the key raw materials to the clean energy transition. So that means lithium producers, nickel producers, as it relates to lithium ion battery packs. It means copper producers as it relates to the decarbonization of everything. At a very elemental level, what the clean energy transition actually means is moving from one set of raw materials, oil, coal, natural gas, that are poisoning the planet at an existential level, to a different set of raw materials that are going to enable us to be finally weaned off of those, but do have their own local environmental issues, oftentimes social issues as well. The key difference is we believe those local environmental issues, the social issues that most raw material producers will expose you to, are manageable risks. And you can select for those that are the most manageable, that have the best practices around that in terms of the practices themselves and the level of disclosure that they're willing to provide. So certainly that would be an example of a set of companies, an industry that we're investing in because we feel it's absolutely essential to the clean energy transition. You simply cannot have the clean energy transition without massive amounts of these clean energy transition materials, but they are going to get you sideways with certain types of more, I'll call them, ESG 1.0 kind of more exclusionary types of ESG investors.
Yeah.
Katherine, could you answer the same general question, how dealing with complex products that aren't, solely on the side of the angels, one might say, but have a real value, and you have to weigh the pros and cons, and they come out, pro.
Yeah, absolutely. You could see me nodding and smiling as Kim's talking here, because there are indeed still a lot of settings that approach sustainability as kind of an either or, yes or no, good or bad sort of sorting exercise. And it's so much more interesting when you get up close to a product or a service. And so the example of raw materials going all the way through to application is a really key example to give. Very early on in my time at Putnam, I remember meeting with a group of clients, and we were talking about some of these really interesting interconnections and, just how things get made. The old Richard Scarry book, like, what do people do all day? Where do things come from? So really kind of refreshing conversation. But at the end of it, one person came up to me and said, I just wanted to buy an electric vehicle, and now I got to worry about, like, where does cobalt come from? So, well, okay, you don't have to worry, but like someone has to worry, and I like worrying, right? So, to really be, I think, in high integrity in terms of our intellectual integrity and tracing through, if you want a solution, A, is it really a solution, right? And kind of testing that premise, and then B, testing exactly what's required to get that solution out into the world. One example from our portfolios that we get a lot of questions on in this regard is our utility exposure. We currently own just 2 utilities in our Sustainable Leaders portfolio, and indeed, they currently are very carbon intensive. So if you only look at current carbon intensity or past carbon intensity for these 2 companies, it's really notable. There's no way around it. That's how utilities have historically been structured in the United States. But again, our work aims to be context specific and forward looking. Our premise here is that this transition to renewable energy is one of the most important central transitions that we can back in order to have a positive impact on climate over time. You can't have the transition without actually transitioning and moving forward. So the two utilities that we've picked have really tremendous leadership in this regard. One is the largest solar operator in the United States and adding capacity at an extraordinary rate. The second has a forward-looking backlog of power generation projects that is 95% renewables. And so sure, we want that transition to happen as quickly and effectively as possible. But if we just screen them out based on historical carbon intensity, we couldn't be part of that move forward. And so again, this is a little bit more nuanced question. There are some subsegments of investors who don't have any time for that nuance. But if you're really looking, again, to align thoughtful investment decisions with potential impact in the real world, not just a report on a spreadsheet, that says I'm not carbon intensive, but like actual change in the power systems. This is the kind of connection that we think is worth making.
Could I'll just add
Sure.
one to that, because we also invest in utilities for exactly the same reason. And the other important role that utilities sit in an excellent seat in terms of affecting the overall clean energy transition is in that transformation of the electric grid, from the old centralized, I'll call it, dumb grid that could really only accept the very centralized natural gas, centralized constant power supply, to an electric grid that can accept those power sources that tend to be more widely distributed, more intermittent, which almost all clean energy power solutions are at this point. And so we also invest in those. You look at our exposure, and we have a decent amount of utility exposure in the portfolio, but then you can compare the carbon emissions of the utilities that we own versus the carbon emissions of broad market utilities. And even though, to Katherine's point, they're still depending to a certain extent on fossil fuel power generation, they're much less carbon intensive than the industry overall.
Mm-hmm. I would say, Alan, maybe just to loop together these points of the conversation, Kim made a really important point earlier. If you want to just look at a paper as an ESG or sustainable investor, you just want to show like a carbon light portfolio. There's some really great, intellectually rigorous, high integrity ways to do that, and there's some kind of lame ways to do that. If I own nothing but software, I look pretty good on most of those report cards. That may or may not be what we're really trying to do here. And so moving to this phase, as I think we firmly have now, where you're asking the harder questions, we're asking about things like, how the built environment of stuff is going to transition to a better place environmentally. That's a much different question than how can I just make this number for my little portfolio look smaller. And so again, there's a place for all these solutions. I'm not saying one's good or one's bad, but to be really clear on what we're trying to accomplish with our different investment approaches is essential.
In a different direction, how do you think about, let's go back to Kim. How do you think about technological disruption as it comes to strategies? There's so much research going on at the academic level, in the venture capital world, about storage technologies, electrification. Obviously, you are looking to invest in great companies, but also you're not looking to invest in a company whose technology becomes outdated in 2 years. How do you try to keep up with all of the change out there to make sure that you don't end up with a great product now that is a buggy whip 2 years from now?
It's a great question, and I think I'll start by saying we absolutely need a whole lot of technological disruption to solve the climate change solution. We've already talked about, we don't have enough copper. There's simply not enough copper, nickel, lithium, cobalt in the world to power all the electric vehicles, all the charging stations, et cetera, that we're going to require. And so we're going to need to develop, at a commercially viable level, substances like graphene, some of these superconductor materials that are out there right now, but they're just not nearly commercially viable at this point. But to answer your question directly, you're always going to be exposed to technological disruption as an investor in this space. It's one of those spaces that is, most prone to that. I think an advantage of a public equity portfolio like Katherine and like Putnam and GMO manage is that it does allow for more diversification. So you're going to have smaller positions in companies, and so that's going to give you more diversification, but you still need to pay attention to that. So when we're investing in certain battery technologies, et cetera, certain solar inverters, we're thinking about things like how susceptible is this particular technology to disruption. With lithium-ion batteries, there's continuing to be developments made in terms of solid-state lithium-ion batteries. There's continuing research going on that could get us off of lithium-ion batteries altogether. And then to your point, Alan, the question of what do you do about utility scale storage? That's really one of the big nuts left to crack in terms of how do you do that efficiently? Is it going to be vanadium flow? Is it going to be some kind of physical, mechanical process of storage? And so you need to just continue to be diversified, continue to stay up to speed with what's going on, not only at the public equity level, but a sort of further upstream from an investment standpoint at the venture capital level, at the private equity level, where and we can get some visibility into that. At GMO, I think our best pipeline in terms of our visibility into that is through Jeremy, because Jeremy is and the foundation is a very prominent investor in early stage venture. And so we get a little bit of visibility that way, but you're always going to be exposed to that to a certain extent. Diversification is your best protection from that type of risk.
Katherine, anything to add to that?
Yeah, I would just maybe amplify a couple of things that Kim just alluded to. There are a few different layers embedded in the question. One is the research layer. How do you know what's coming along? And again, as active managers in both of our settings, you have a great chance to craft your own research agenda as well, right? So you can talk to scientists, you can talk to early stage entrepreneurs, you can talk to existing incumbents, and you put all those pieces together, you get a much more complete view than if you're only talking to existing large public companies, right? You want to kind of expand that aperture on the research side. In our case, that also involves my work with the Santa Fe Institute that you mentioned earlier, Alan. If you're thinking about things like big systemic transitions, in addition to answering the micro level technological advancements that might be important for any given product, to put equal attention to all the different pieces of a system and what influences decision making and why. I'll give you a quick example there just to bring it to life. A few years ago, when we first were starting our work at Putnam, we spent a lot of time on the West Coast with different folks engaged in the solar industry. And what we started to hear in those conversations was, in addition to being focused on cost and economic parity, which we alluded to earlier, the comments around reliability and availability of power were getting louder. So it wasn't only a cost decision for the folks who were buying into those systems, it was also an ability at the household level to control your own destiny a little bit more, to potentially have backup power with blackouts becoming more frequent and disruptions. That's a really different backdrop for decision making than existed before. So again, there's the technological element, there's also the decision making element that I think is worthy of research, and you can connect all that in a really direct way to your company specific models. The last piece that Kim also alluded to that I think is really key is you can map out as a portfolio manager how much risk you want to take and where. So if you see 3 really fantastic emerging solutions in energy storage that seem interesting, but none of them is really easy to forecast at this point, you might not choose to make them your top 3 positions in the portfolio, or you might choose to own all 3 instead of just one. So there are a lot of things related to portfolio construction that I think are sometimes skipped over in these conversations. So I'm glad we're having a chance to talk about that part as well. It's not that you only take the menu that's handed to you, you get some volition in terms of what you do with it.
Similar question. Public policy obviously has a huge impact on climate and on portfolios, especially with administrations that have changed, swung from one side to another. Do you spend any time thinking about the impact of changing governments, whether in the US or abroad, or just changing domestic legislation on how that might affect the ways to construct a portfolio? Katherine, could you answer that one?
Sure, I'll give a start. Policy is indeed important, as you mentioned, so certainly can't be ignored. We spend a fair amount of time keeping up to date on policy of all sorts. Also learned perhaps the hard way over 30 plus years, it's sometimes harder than you'd think to forecast policy. And so we try pretty hard not to have too much exposure to the outcome of any one specific policy a priori, right? So once something's in place and you can model how it might play out over time, that's a perfectly logical path of research to follow. But we don't want our portfolio to be dependent on a policy outcome where we have no advantage in assessing its potential success. So those are the pushes and pulls. I'll also note it's gotten awfully complicated across regions of the world, but also individual states, individual municipalities in some case, like policy goes all the way down. And so sometimes I find we overemphasize national or international policy and maybe underemphasize those local level decisions that really influence a lot of activity like on the ground. So the mix of all those is a really important set of inputs.
Kim?
Yeah, just to add a little bit to that, I think Katherine's points are spot on. We think that we also believe it's a really hard, short-term prognostications around moves in policy are really hard. And so our underlying philosophy, I think, can best be described as we believe that the long-term policy trend is positive. There's going to be a lot of volatility, administration to administration, but even the impacts of, an administration that is not favorable to climate change policy can have unintended effects. And so when you think about the 4 years that the last administration was in power, certainly no one would have described that administration as being favorable, being conducive to supporting climate change, investment, et cetera. And yet what you saw happening was within the United States, you saw states, municipalities, private corporations stepping in to that void. You also saw that as a catalyst to probably faster policy change globally because there was this void at this very important economy. And so certainly short-term price swings, short-term swings in sentiment are going to be hugely impacted by whether or not something like Build Back Better is passed or not. And you can see that impact on, all things solar, all things wind. But over the long term, the policy support is moving in the right direction. And so we don't spend a lot of time, we don't think about making predictions around that as part of our overall investment process. We pay attention to it. We recognize that it can cause volatility over the short term, but over the long term, it's going to be less consequential.
Moving over to a company-specific issue, do you engage with companies, the public companies that you invest with, regarding their policies and their processes? And if you have engaged with companies, what's their response been, and has that changed in the last 5 or so years? How about Kim on that one?
Yeah, so we absolutely do engage. Our overall philosophy around ESG is, we think of our philosophy around ESG as being risk-oriented and forward-looking. The forward-looking part of that requires that we do engage with management. When we identify something on the environmental side, the social side, or the governance side that we feel could be moved in the right direction, we're absolutely going to engage around that. or if we feel that the disclosure around a particular issue is simply not adequate. I would say where we've seen the most significant change in the course of the last 5 years is in management recognizing the importance of disclosing adequately around these risks, because more and more people are paying attention to it in a very important way. Now, our strategy has, in round numbers, between $1.5 billion and $2 billion in aggregate in AUM. We recognize that we're not going to be a huge force. We're not going to be a very loud voice individually when we're engaging with management, but we can collectivize around that by being very active members of organizations of like-minded investors, and we absolutely do that as well. And so I'm not going to hold our strategy out as being sort of activist oriented, but we do feel we can nudge companies in the right direction towards better practices, both in terms of, if we're thinking about specific issues such as items like tailings abatement practices for some of the copper producers or nickel producers that we invest in. We can nudge them in the right direction there. And then also just continuing to stress the importance of absolutely transparent disclosure around all of those issues.
Katherine, what's your take on that?
Yeah, some parallel observations. Engagement as an active manager has some really interesting and important dimensions to it. So engagement for all shareholders involves proxy voting, sometimes collaborative activity, sometimes advocacy for improved disclosure, for example, on a broader scale. All of these are really important. The thing that's a little bit more unique to an active manager's setting is the fact that our research process itself has a lot of engagement embedded in it, right? So we're talking to the leadership teams of companies we're invested in and companies we're not invested in all day, every day. And so being able to make those links between long-term strategy and key sustainability issues is a real potential asset, I think, that we have from this active management position. In addition to that all day, every day kind of research activity, one thing that our team does at Putnam is every year we write a letter, personal individual letter to the CEO of every company we're invested in the sustainable portfolios, as well as our top equity holdings. And in those letters, we highlight a couple of the key reasons we're invested in the stock, things we think are going really well in terms of those relevant sustainability issues we've been talking about. And then we highlight areas where we are looking forward to learning more about their progress. And so it's very encouraging in tone, not because we're cream puffs, but because we already have chosen these companies, right? Like, this is already a very small subset of all the companies in the world. We wouldn't own them if we didn't think there was something really exciting and good that was happening within them. I cannot tell you how great the response rate has been to those letters. The fact that it's not a form letter, that it's from an actual human that they've met with, and that it's strategically focused and tailored to their own business has led to terrific follow-up conversations, really has amplified this ongoing dialogue. It's very hard to report on when someone gives us like a checklist to report on our engagement activity. So that's a little bit of a downside, but I would trade the positive impact and the candor of those conversations for the ease of paperwork any day. So that's where we focus.
Sure. A little broader question, if how are investors using your strategy? Are they typically, is it a small carve out of a broader global equity portfolio? Do you have people or organizations who are getting the bulk of their equity allocation through you? What do you understand how people are using your funds, Kim?
Yeah, so there's, I would say that there's not a monolithic answer to that, but there are certainly trends around that answer. And so I would say by and large, the investors that are using our strategy today, I can't think of any that are using it as their sole equity exposure. But there are a number of investors that use GMO's climate change strategy as part of their overall ESG bucket, if they have an ESG bucket or sleeve. Ours is not, our strategy, I think most people recognize, is not meant to be sort of a generalized ESG or even a generalized sustainability solution, but it is a very specific niche that fits nicely in to a general ESG approach. So that's one usage. Another usage is just as a differentiated source of alpha for an overall global equity portfolio, because you should certainly fully expect to earn an equity risk premium by investing in in the climate change universe. But that equity risk premium should be layered on something quite different from general global profitability or general global economic growth, because it's unique to this long-term secular tailwind around the climate change solution. So as a diversifier and a diversified set of source of alpha within an overall portfolio. And I would say one other usage that we're beginning to see a little bit more of, it's a combination of things. It's thinking of this as an alternative way of getting real asset exposure. And what a lot of people are looking for real assets to do within a portfolio these days is to provide inflation protection. But if you're just going to go out and buy a general resource equity portfolio or a general energy portfolio, you're going to be exposed. You're going to own a lot of fossil fuel exposure. This gets you something that looks very, very similar and has a whole lot of correlation with that, but doesn't expose you to having to own fossil fuel producers.
And Katherine, do you know how people are using your strategy, or what range of ways people use your strategy?
I do, and I also have a wish list of how I want them to be used. So we can talk about both. Your question alludes to a really important backdrop, Alan, which is right now, if you look at almost any survey of investors, whether next gen or broader surveys of investors, somewhere between 70 and 90% of individuals are interested in investing this way, and not just generically interested, but like ready to take action or have already taken some steps. That's not only true for Gen X, it's true, or millennials and kind of upcoming folks. It's true across broader populations. I like to say, like, even like old guys, right? Like, you read a lot about women, you read a lot about next gen, but like the general population trends are all very strong. So that's a huge, huge number. If you ask financial advisors how many of them are actively incorporating sustainability oriented portfolios, or even having sustainability oriented conversations with their clients, it's somewhere between 15 and 20%. That's weird. It is really unusual to see such a big gap between what people say they want and what the folks who are helping them say they're offering. And so there's a fantastic opportunity here, I think, for anyone who's engaged in financial advice giving to get on the bandwagon and have some discernment in terms of what they want to do in this arena and what they want to offer. Our products are a little bit different from Kim's in that we don't have solely a climate related focus. We have climate as a focus within this broader sustainability mandate. So my goal is, if you are looking for a fantastic, larger cap, moderately growth oriented portfolio, our Sustainable Leaders portfolio should be center of the plate for that. And also, if you are looking for a terrific sustainability oriented large cap portfolio where it's going beyond this ESG check the box kind of approach, we also should be on your list. So my colleagues here are tired of me saying, but like, we want all the money to be invested this way over time. It shouldn't be relegated to like around the edges of the investment plate. And again, we talked earlier about how, from a portfolio perspective, we have so much to work with now. It's not so hard to create a fully diversified portfolio. The same is true for anyone who's putting together a portfolio from a broader investment perspective. There are so many really interesting and worthy products out there that whatever it is you're looking for, the menu has gotten better and better. It's gotten more and more complicated, so you got to do some work, just like we do, to find those stocks that we want to buy, but it's plenty of ingredients to work with.
Kim, you alluded to the portfolio having some leverage to inflation, that it's it being real assets that should have some correlation to inflation, which obviously is of value to investors. Are there any other ways that you found that your portfolio, other areas, other factors that your portfolio is leveraged to, that either you were or were not expecting as it's played out over the last 4 or 5 years?
Yeah, so if we think broadly about factors and the factor exposure that our portfolio gives you, I'll reference our portfolio relative to its benchmark. Its benchmark is MSCI ACWI. on one dimension, MSCI ACWI is a great benchmark for this portfolio. If you're thinking about this is a portfolio that's going to be, it's going to be a carve out of your overall global equity portfolio, then you can think of MSCI ACWI as being the funding cost or the opportunity cost of this portfolio from a return standpoint. And yet our portfolio looks substantially different from MSCI ACWI. The way it looks the same is it's very broadly geographically diversified. That's why we've chosen it as the benchmark. But our portfolio, while we think about it as being an all cap opportunity set, realistically speaking, because we're focused on these climate change solution business models, they tend to be mostly smaller cap companies. And so we definitely have a smaller cap factor tilt to the portfolio today. And the one that's probably most surprising to people when we, when you hear that we manage a climate change portfolio, because we do have this valuation focus as we're selecting stocks within the universe, we actually give you a pretty substantial value tilt versus MSCI ACWI. And that's a pretty potent combination. So you're investing in this universe that has these attributes of long-term secular growth tailwinds. And yet, because we have a valuation focus, we're able to put this portfolio together that trades at a substantial valuation discount to MSCI ACWI. And there's a lot of people, investors today, that are trying to make that decision. Where are we within the overall growth value, rotation, et cetera? And here's a portfolio that can give you a nice smattering of both.
Mm-hmm.
Katherine, how about you, let's say with respect to the sustainable futures portfolio, what kind of exposures does it have?
Yeah, so sustainable future, as I mentioned earlier, is that solutions-oriented portfolio. It naturally skews a little more towards mid-cap growth. I'm thinking as we're talking here, if you put this together with what Kim just mentioned, like that's kind of a cool combination.
Yeah.
It's very hard to get, the growth and value attributes kind of balanced, if you will, in this arena. So it does have that mid-cap growth focus, also has mid-cap growth benchmark, Russell mid-cap growth. This has been a tough area for the last 6 months, an extraordinarily great area for the few years before that. So we aim in all of our portfolios for the stock picking to shine through, which means we manage all sorts of other risk exposures, pretty carefully and very actively. And so again, if you're doing that really thoughtful research work that we've been talking through all throughout this session, we think that stock picking ultimately is where you're going to generate your alpha, and that's our goal.
Great. I'm going to get a little further away from your own core. And ask a question about divestment. I run into that with some clients who are looking for portfolios that just don't have energy, don't have fossil fuels, or some other area. Do you think there is any value to the divestment of sectors or companies in the broader investment workplace? Katherine?
Sure, I can start. One thing that's important, I think, for all of us as investors is to think about all the different tools we have to use and which tools make sense in which combination. So what are the potential advantages to divestment? First, it is easy to execute. So it's very straightforward. You're in or you're out, and there's not a lot of complication in terms of how to get it done. The second is a little more subtle but important. If you really have a massive movement to divest over time, the long-term cost of capital for companies does shift, and and that's important. I don't want to diminish it, but it's a little bit of a blunt instrument, shall we say. And for a lot of folks, as you mentioned, Ellen, it's just important to say, you know what, I have nothing to do with this certain sector or certain type of business. That's a really important consideration. The other tools we have to work with, we've alluded to earlier today. So we've got the investment work, we've also got the engagement work. So I think to own a company that you are concerned about and to also not engage is not a great thing to to have to defend in the world. There's really kind of no excuse for that at this point. But to own a company that you think is doing some great things, might be able to improve in some other things, and you have that active engagement already happening, like that's a really different backdrop. So again, we're active managers. We own relatively concentrated portfolios. I don't own any stock that I don't feel really great about explaining to the world in terms of its authentic sustainability credentials. And also we have this tool of engagement that is important. So I think, again, for folks to think through what is the most leverage that you have in any given situation, and to tailor things accordingly is key. But I hear a lot of conversations that start and end only with divestment, and that always concerns me. You know, it's one tool out of a pretty big tool set.
Great. Just got a question from, I think, I hope I get the name close to right, Ishan Sokar, and she asks, how do you view oil and gas companies that are still very reliant on fossil fuels, but are also making progress towards renewable sources of energy? Kim, could you take that one?
I'll start with that. So we don't have any portfolios. We don't have any names like that in our portfolio today. There is, as we think about who belongs in our universe and who doesn't, one of the edicts that we stick to is that we require at 50% of a company's revenues to be directly associated with one of the themes that we've identified. You know, whether it's clean energy or electric grid transformation or energy efficiency, et cetera, et cetera. And so at some point in the future, we could see, you know, one of the, you know, obviously we're all seeing the large integrated oil majors, for instance, move slowly in that direction and talk a whole lot about what they're doing as they move that direction. We've also seen what's gone on in terms of, you know, the makeup of Exxon's board, for instance. Yet none of those companies are anywhere near seeing anything close to the majority of their revenues associated with the clean energy transition. Now, they are going to be important. They need to be important parts of the solution, whether we're talking about, you know, becoming players directly in, you know, major players directly in the production of renewable energy, or perhaps more realistically, making very important steps around sequestering carbon. And so they do fit in they ultimately can fit into the theme. They don't belong in our portfolio today for sort of construction reasons that I've already discussed.
Great. Well, we're getting towards the end, so I'd like to maybe close out with an open-ended question for each of you. Do you have confidence, and what gives you confidence, if you do have confidence, that investors can and will play a positive role in climate change? Katherine?
Do I have confidence? You know, when I came to Putnam 5 years ago, I had been coming from an independent perch. I spent the first part of my career at a very large financial institution, was doing independent research, all sustainability oriented. It was a big question for me whether or not to come to a bigger organization again. And this was one of the main reasons. You know, would I feel like I was battling windmills, no pun intended, like every day? Or would I feel like I was really contributing to something that was like a generative solution? And it has been so much better than I thought for a few reasons. One is there is so much happening within almost every company we talk to, whether we own them or not, whether they're a fit for our portfolio or not. So folks are taking this work seriously and they're moving very quickly. We're not there yet, and some of it's a little bit behind the scenes, but that is really hopeful. The engagement of my own colleagues, way beyond my own team at Putnam, has similarly left me very hopeful. But I do draw a distinction. You know, I love this passage from Václav Havel. He made a distinction between hope and optimism. He said optimism is this conviction that everything's going to turn out all right in the end. Hope is something different. Hope is the idea that something is worthy of working towards, no matter what the outcome. And so I am deeply hopeful and occasionally optimistic.
Great. Kim, any thoughts?
I really like what Katherine said, and I think what I would add to that alludes to what we've already discussed previously in this conversation. You no longer have to choose between doing the right thing as an investor and trying to make money as an investor. You know, we've passed an important inflection point where the foundational economics are in place, and because of that, we're going to continue to attract smart capital, and capital. You know, I think that purely mission-oriented investment is never particularly long-term sustainable. It just ultimately investors require some kind of a fair return. And there's an excellent opportunity today because of where the economics of the clean energy transition stand today. The major issues that we still really need to solve are scale. Scale requires a lot of investment, so that's a good thing. And I would say intermittency, which relates to the large scale storage, the utility scale storage. I think that's going to be one of the more exciting areas of technological research that's going to be ongoing from here. But I would say that I am, as with Katherine, I am definitely hopeful, and I'm much more optimistic than I would have been 5 years ago or 10 years ago. And it has everything to do with where the economics are today.
Great. This has been a fascinating conversation. For me, it's been educational, and I'm really enjoy hearing the exciting work that both of you are doing at your firms. And I'm appreciative of the time that you've spent, and hopefully everyone else has gotten as much out of it as I have. So thank you very much.